A bear market is typically defined as a condition in which the price of a security or an index experiences a decline of 20% or more. And using that definition, we are officially in a bear market. But the real questions that we have as investors are, is the market going to go down another 20%? And when do we know whether or not the market has hit its bottom? And how can we as investors successfully navigate and invest in this bear market? In this video, I'm gonna show you why you should view this bear market as an opportunity. And I'm also gonna show you how to successfully invest in this bear market, because contrary to what you may be thinking, history has shown us that bear markets are the best time to invest in the stock market. With that being said, let's start this video by showing you why you should be viewing this bear market as an opportunity. And to showcase this, let's take a look at this table that I came across as part of my research for this video that breaks down each one of the prior 15 bear markets that we've had since 1950. This table outlines a peak and trough of each one of the prior 15 bear markets. It also outlines the total percentage decline of each one of those bear markets, as well as the number of days it took the market to reach its bottom from its peak. And then it shows the break-even date and the number of days and years it took for the market to recover to previous levels. Feel free to pause this video if you'd like, but the reason that I'm showing you this table is that since 1950, the S&P 500 has been in a bear market 15 separate times. And the market has not only recovered to its previous level each one of those 15 times, it's gone on to make new highs within an average time span of 1.7 years. Now, as you can see, some bear markets lasted longer than others. The bear market of 1973 lasted 2,114 days, or 5.8 years. And the bear market of 2000 lasted 1,694 days, or 4.6 years. And the bear market of 2007 lasted 1,480 days, or 4.1 years. But outside of those three outlier bear markets, none of the other 12 bear markets lasted longer than 2 years, and many of them lasted less than 1 whole year, for an average bear market length of 1.7 years. If we use this average of 1.7 years for the bear market that we are currently going through, we'll reach the bottom of this bear market towards the end of 2022, and we'll be back at previous highs by July of 2023. Now, it could be shorter or it could be longer. There really is no way to know. Only time will tell. After seeing this chart, it gave me a lot of relief, because on paper, judging from the past 15 bear markets, a 20 or 30% market decline assumes that this one will also be temporary. But in the middle of a bear market like the one that we're in right now, our brain only assumes that things will only get worse. Author Morgan Housel best summarized this phenomenon in a recent post. He said, "All past declines look like opportunities, and all future declines look like risks. It's one of the great ironies of investing, but it happens for a reason. When studying history, you know how the story ends, and it's impossible to unremember what you know today when thinking about the past. So it's hard to imagine alternative outcomes when looking backward, but when looking ahead, you know there are 1,000 different paths we could end up on." So my advice to all of you watching is that this bear market should be viewed as an opportunity that doesn't come along very often. Just remember that the best indicator of the future is the past. And past bear markets have shown us that bear markets are temporary. The question now becomes, what is the best way to invest in this bear market? Do we invest in technology stocks? Should we buy growth stocks? Should we buy energy stocks? Or do we buy dividend stocks? And the answer is none of the above. The best way for the majority of us to invest in a bear market is to dollar cost average into an index fund, like an S&P 500 index fund ETF like Vanguard's VOO, or a total stock market index fund like VTI. Let me explain. Many of us are extremely tempted to buy individual stocks, and there is nothing wrong with that. But let me show you why investing in individual stocks and trying to time the market is probably a terrible idea for you. The first reason is that successfully investing in individual stocks is extremely difficult. The fact is that close to 90% of professional money managers, yes, I said professional money managers, underperform index funds like an S&P 500 index fund or a total stock market index fund over 10 and 20-year periods. So let's be honest with ourselves. If 90% of professional money managers can't outperform the S&P 500 over an extended period of time, Do you really think that you will be able to? The second reason is that investing in individual stocks is extremely time consuming. Yes, you may be able to learn a lot about an individual company and you'll learn a lot about what's going on with the economy, but at the end of the day, I can tell you from personal experience, it's just not worth your time to invest in individual companies. Professional money managers listen to quarterly earnings calls. They have one-on-one talks with company management, and they go to industry conferences, and they also perform exhausting financial statement analysis. Now, if 90% of these professional money managers who spend countless hours analyzing stocks can't outperform an S&P 500 index fund, why are we wasting our time? And the third reason buying individual stocks is a terrible idea is that it's really emotionally draining. Individual stocks crash more often, they are more volatile than the stock market, and frankly, buying individual stocks just isn't good for your health. The truth is that most of the overall stock market gains come from just a handful of the thousands of stocks that are available to purchase. And trying to figure out which stocks those are going to be simply isn't worth the time or energy. And because of these three reasons that I just mentioned, it is much more effective to just dollar cost average into a low cost, tax efficient, diversified index fund like an S&P 500 index fund or a total stock market index fund. Dollar cost averaging is a strategy that works in all market environments. It works in up markets, it works in sideways markets, but most importantly, dollar cost averaging is the best strategy for bear markets. But to really show you why I personally think that dollar cost averaging is the best long-term investing strategy really boils down to 4 reasons. The first reason is that dollar cost averaging is simple. You see, markets are oftentimes described as these very complex systems, and they are. But just because the market is very complex does not mean that investing has to be. And that is where dollar cost averaging really shines. By simply buying into an index fund at a pre-established interval doesn't require a lot of brain power. You can simply automate the process and get on with your life. The second reason is that dollar cost averaging allows you to diversify across time. You see, markets are always and forever cyclical. But the problem is that we don't know how long these cycles are going to last, and we don't know what the next cycle will look like. I've been actively investing in the stock market for about 15 years, and I've already lived through inflation, high interest rates, low interest rates, booms, busts, bull markets, market crashes, and everything in between. There is no strategy that will perfectly nail each one of these economic cycles, but dollar cost averaging comes pretty darn close. By buying on a set schedule, you're diversifying across time and market environments. And by doing this, some purchases are bound to come close to nailing the bottom of the market. Others will come near a temporary top, but when stocks are down like they are right now, you'll be buying more shares at lower prices, higher dividend yields, and lower valuations. The wonderful thing about dollar cost averaging is you don't have to try to predict tops and bottoms because you're spreading your bets. No single purchase will make or break your portfolio. The third reason is that dollar cost averaging is the best way to invest in a bear market. Although it may never feel like a good investment exists during a bear market, it turns out that investing in a bear market will almost always be the best investment you make. Take a look at this chart that was published by the economics department at Yale University. It shows the returns of a simple investing strategy that invested $100 a month into the S&P 500 starting in 2007, right before one of the biggest crashes of all time. And as you can see from this chart, the best purchases that yielded the highest return on the monthly $100 investment happened during one of the biggest market crashes in the history of the US stock market. Now feel free to pause this video, but what I'm trying to communicate here is that by buying into an S&P 500 index fund during 2008 and 2009 probably felt like a terrible decision. But as you can see, it paid off handsomely and provided the largest growth to the portfolio. I get it. It seems totally counterintuitive to invest during a bear market because there are so many unknowns. There is the unknown of where the market will be in a couple of months from now. There's the unknown of interest rates, and there's the unknown of geopolitical events. But the reality is that each one of the prior 15 bear markets dealt with some, if not all, of these same unknowns. A wise friend once told me that it's time in the market, not timing the market, that makes you wealthy. With that being said, you need to think about this bear market with a long-term lens. You need to view this dip, regardless of how long it lasts, as an opportunity to dollar cost average into a low-cost index fund that outperforms professional money managers. Do you know how many times I wished I actually had money to invest during the global recession of 2008? Now, unfortunately, I was just coming out of college and I didn't have money to invest, and that's why I look at the market environment we're in right now and see a great opportunity for me to buy stocks at a discount. I truly don't want to be 10 years in the future wishing that I would have invested my money more heavily or that I would have increased my contributions to my retirement funds during this bear market, and I don't want you to be in that boat either. And based on my research, dollar cost averaging into an index fund is the best way to invest during a tumultuous market environment like the one we are in right now. With that being said, thank you all for watching this video. Please remember to like and subscribe, and I will see you all next time.